Hi guys, my name is Ara and this is Rozara's Investments. This is a relatively new channel, so to help me advertise, please subscribe and share on Facebook. So today in my video, I will be talking about the FANG stocks, F-A-N-G, Facebook, Amazon, Netflix, and Google. And I'll also be talking about some other companies that many people are interested in, Apple, Microsoft, Alibaba, and BIDU. This is a company for the active traders. I will be looking at relative overvalued or undervalued versus their moving averages. So that's a slightly advanced topic. I'm going to try to break it down a little bit, how I determine how something's overvalued or undervalued relative to itself. And we have had a terrible Friday and a somewhat terrible Monday. All last week was terrible. Today's been terrible in the market. I don't even know how much the market is down, probably around 0.5%. So it is Monday, February 5th, and let's get to it. So one site that I like to use, which I have my own accounts at, is Fidelity. So this is a chart. This is a 2-year chart of Facebook, okay? So I'm going to keep all the charts very consistent. The blue line in the middle is a 100-day moving average. It's the average at any point in the line. It's the average of the last 100 days of what the stock was trading at. So if you can see my cursor right here, okay, we're looking at May 15-ish, for example, and we can see over here that the moving average. Oh, I'm sorry. You got to look right here. The moving average for May 15 was 136. So the average of the last 100 days was 136. And the upper envelope, which is the top line, is 163. MAE stands for moving average envelope. So as you can see, Facebook stays kind of within a range. It is between its moving average and 15% higher. Or I'm sorry, in this chart I put 20% higher. So let's actually change that to 15%, just to make it a little bit more consistent, more applicable to Facebook. Okay, so now as you can see, Facebook is staying between its moving average and the upper envelope of its moving average, which is 15% higher than the moving average. So as you can see on the left side of the chart, the moving average is not as wide, and the right side of the chart, 2 years later, it's a little bit more wide. So way on the right side, we can see that Facebook, the moving average right now is $177, and the upper edge is 204. So this gives a very, very easy and quick visual as to how Facebook is compared to itself. And I've brought this up first because I have traded Facebook a lot. Those of you that have been watching my channel and that know me know that I trade Facebook very, very often. And every time it dips down, like over here, September 25th, I actually, even before that, in July 3rd, around there, I bought some options and it had that big run up. When it dipped down over here, I ended up buying an option, and one or two of the other times when it dipped down to the moving average. And Facebook is generally one of the most predictable stocks, where it will go down close to its moving average, and then it's going to have about a $10 run up. And then it goes down again, and then it has about a $10 swing. And it has in the ballpark of $10 swings. It's not exactly $10, but I think anyone with eyes can see that it goes down and then it goes up, and it goes down and it goes up. So Facebook, in my opinion, is right in the middle of where it should be. So not knowing anything else about this company, I would say Facebook is fairly valued. So I also like to use big charts, and I brought up a 3-year chart of Facebook. On the top left, you can see it's Facebook. And this is a 3-year chart, as you can see in the middle. And one thing I love about using the Big Charts website is we get to look at the trailing earnings per share. And I guess I can't highlight that word, but right near where my cursor is. So trailing earnings per share is very, very useful. You can also call it, some websites call it rolling earnings per share. And at every point in the line, it is the sum of the last 4 quarters. So as Facebook takes a step up over here, this quarter gets added to the rolling average, the rolling earnings per share. And the quarter now 5 quarters ago gets deleted. So at every point, this is the last 4 quarters, the last 4 quarters, the last 4 quarters. So if Facebook is making more than it did in the year ago quarter, then this will kind of look like a staircase, and it's going to be earning more and more money each and every quarter. So this is what it should look like. Facebook is a perfect example. So every quarter, Facebook is making more, and their rolling earnings per share looks like a staircase. And somewhat due to this is also a textbook case of how it should work, is when Facebook was not earning that much money, the PE ratio was still very high. They were in a super growth phase. Not that they're not in a super growth phase now, they are. But they were in a super growth phase before. And the PE ratio was going higher and higher. And it looked like it topped off around 105, 100, 108 maybe. And then as Facebook is earning more and more money per share, now the E in the P to E ratio is getting bigger, which makes the total ratio go lower and lower. Over here, it looks like it was in the 60s. Over here, it looked like it was in the high 40s to 50 PE ratio. Over here in the 40s, over here in the 40s, over here in the high 30s. Now it looks like Facebook is in the mid 30s. So the PE ratio is going down and down, but because of the strong earnings growth, as we can see in the rolling earnings per share, Facebook is going up and up. So I would just really quickly, not like to spend as much time on every other stock, but just really quickly go through the other 7 stocks on the list. So next we will look at Amazon. Okay, and Amazon is currently about 1,400 and change per share. And this is a 2-year chart of Amazon. And as we can see, the moving average is 1136. 15% higher than the moving average is $1,300 and change, 1,308. And Amazon is 1,435. So it's just a very easy visual to see that Facebook is way higher than where its moving average is. So as far as the fundamentals of the company go, that's another thing. But as far as from a trading point of view, I am not sure new investors should be getting in right now. If we can look back in time to about September or October, it looks like you get in about $900 a share, and that was actually below where its moving average was. So, and it does look like every so often, every stock goes below its moving average. You can't stay above the moving average forever. But see these times when it's below the blue line, that is when it's pretty much a terrific time to get into the stock of a growing company. So Amazon way above its moving average. Let's just look at Amazon real quick on big charts, because this gives you some slightly different information. And Amazon, anyone with eyes can see that Amazon is very expensive right now. Their earnings look good, but really Amazon is traded based on revenue and technological advances they're doing with the company, like AWS is super important. And so their earnings per share and their PE ratio don't matter too much. But it is nice to see that they are starting to earn some money. I guess some people want to see that Facebook is eventually going to earn some money. So let's go to the NFLX. I had to do that from memory because I don't own any Netflix. Netflix seems very high price to me. So Netflix is in the ballpark of Amazon, where you can see that it was kind of a normal price stock for Netflix, not for regular stock purposes, but compared to Netflix, it was in the normal range. But then in January, it just took a huge spike up. I think they got like 8 million new subscribers or something like that. And while that's good news, it also means that the stock, once it pumped over $284 a share, the closed at this date on January 29 was $284.59. I wanted to buy a put option. My buddy actually talked me out of it because Netflix is such a risky stock. But it seems like I would have been right, and Netflix actually dropped down by about $20 so far. And even though it's dropped down $20, it still looks super overpriced, because just eyeballing it, it looks like it's about 30% higher than its moving average. And Netflix generally doesn't go about more than like about 20% higher than its moving average. So even for Netflix, this is super expensive. So let's go on to the next one. Actually, let's look at the earnings for Netflix real quick. And again, Netflix is kind of like Amazon, where earnings don't matter as much. It's more about the revenue growth and the subscribers. So Netflix, this is a 3-year chart. You can see that Netflix took a huge pop up. It is getting earnings growth according to this. Looks like in the last 4 quarters, they're earning about $1 per share. Now there are different types of earnings. There's all different stuff like diluted earnings. So I wouldn't put too much faith into this chart. And the PE ratio, look at this, it's ridiculous. It's up to 280 something PE ratio, 260 something. So the PE ratio is very high. But like I said, Netflix is not being traded on its earnings. So let's go to the last of the FANG stocks, GOOG. Actually, you know what? I'll do GOOGL. These are the voting shares, and they've been around longer. So Google is not quite in the Amazon or Netflix category. Google is earning a lot of money. They do have revenue growth, and they have a phenomenal balance sheet. The enterprise value of Google is far less than the market cap of Google. So if I had to recommend one of these 4 stocks right now, I would be recommending Google, because even though you are spending $1,093 a share if you bought it today, because Google has so much cash in the books and so little debt, it's actually almost like you're getting the shares for cheaper than they are. And as you can see, Facebook has traded below its moving average a few times, back in May of 2016, in July of 2016, in November or December of 2016, and then again in the summer of 2018. So there's been a few times where Google has dropped below its 100-day moving average. And it does seem like it is dropping like a rock right now, and maybe it will get below its 100-day moving average, and that would suggest that it might be a good time to buy. You have to make your own decisions, but with my money, I will probably be buying Google once it gets down to about 1,040. About another $53 drop, and I will be very interested in buying Google below its 100-day moving average. So if we look at the earnings of Google now, GOOGL. Google has had a very nice run up, like every other technology company that I've ever talked about. And if you look at the earnings, 3 years ago, Google was earning about $21 a share, and now 3 years later, it's earning about $30 a share. So it's making about 30% more in earnings, maybe even a little bit more than 30%, maybe about 40% more. And they've also written off a good amount of money. So in the future, looking at their forward earnings per share instead of their previous 12 months earnings per share, Google is not such an expensive stock right now, because they are earning boatloads of money. They're growing revenues very quickly, and they do seem to be doing all the right things. But if we look at the historical PE ratio chart, it seems like in the past you would have been able to get Google at low points of around 25 in 2015 or 27 in 2016, and right now, even though relative to where it was a week ago, Google seems to be inexpensive, it is still 36 times a share as far as their PE ratio, 36 times earnings. So I would be hesitant to say Google is cheap, but it is definitely cheaper than it was, and looking at its forward PE ratio, it is definitely cheaper than it seems right now. So my daughter owns Google and Facebook, of these 2, and she has done very well on both of them, as a side note. So next on the list, I'd just like to quickly cover Apple, Microsoft, Baba, and BIDU, which are companies that I'm personally more interested in. So Apple, I do own an option in this, and I have not done good. Oops, I typed in AAPL is the symbol. So let's see Apple here. Takes a second to come up. So we can quickly see, I love these moving averages, we can quickly see that Apple is looking pretty cheap right now. It says it's $161.35, and it is below that blue line. So Apple just came out with earnings. They said they sold a boatload of iPhone X's, but the total number of phones that they sold was not as many as last year, as this quarter last year. So that was the concern, although their overall revenue and earnings was more. So you have to decide if that's a good thing or a bad thing. But they are trading below their 100-day moving average, which implies that the stock might be cheap right now at $161. Just a couple weeks ago, they were $178 a share. So I have options that expire in June. I am probably not going to buy more right now, but if they drop down to the 155 range or whatever this low was right here, if they drop down to the 151 range, 149 in that ballpark, right around 150 bucks, I'll probably be much more interested in buying another option. So Apple, I think everyone knows what they do. Let's look at their earnings, and their earnings are probably fantastic looking. AAPL. Here's their chart. As you can see, they do not always go up. This was 2015 leading into the end of the winter 2016. They had a horrible little run. Some people took the chance and bought shares in the 90s, and they did terrific. Their earnings go kind of up and down year to year. Their comparisons, I think over here in this range, they were starting to sell the iPhone 7, which they were comparing to the iPhone 6, 6S and 6S Plus, which was a terrific year, the 6S Plus. That's the phone I have right now. Historically, they've gone down to as low as 10 times earnings, and because they have so much cash in the books and such a phenomenal balance sheet, that is way, way too cheap for the company. So everyone that missed out on buying shares in Apple in the 90s really, really, really missed out, because this stock has done phenomenal, going from $90 a share to $160 a share, which is in the ballpark of a 80% return, plus dividends. Can't forget the dividends. So relatively right now for Apple, the result is you have to make up your own mind. It is below the moving average, which has historically been a good time to buy shares, but who knows what the future will bring. Let's look at Microsoft. I ended up selling Microsoft in my family's account around $70 a share. I was wrong to do so. I just don't understand why Microsoft is growing so quickly. Right now it's $91 a share. And as you can see, it is relatively high compared to its previous prices. So I would not be buying more shares of Microsoft right now. They are growing because of the cloud. They're growing because of Azure. But their overall revenue is not growing super fast. Their overall revenue growth is in the 12% ballpark. So why are they so expensive? Let's see what their PE ratio is. MSFT. Microsoft, as you can see, over the last few years, and I actually bought options when the stock was 29, and I am so disappointed that I didn't keep them longer. I sold them for other reasons, but so disappointed. One of my biggest mistakes in life. So now it's about $91 a share. As we can see, their earnings are erratic. I don't pay attention to Microsoft too much, but this, when it's a 12-month span of the trailing earnings per share, usually it's due to a tax write-off, so that would be my guess right there. And also the PE popped up. You can see it's kind of an inverse chart of the rolling earnings per share. It does seem like in the last 18 months or so, they have been earning more and more money, but the PE ratio is very, very high for my taste. They're trading around, from this chart, it looks like they're trading around 31 times earnings, which for Microsoft seems very, very expensive, considering just 2.5 years ago, you could have bought shares for about 15 or 16 times earnings. They do pay a good dividend, they have a good balance sheet, but I just don't want to be paying 31 times earnings for such a boring stock as Microsoft. That's only my opinion. You can do what you want. Now, a company that I do own, Alibaba, B-A-B-A. Alibaba. Alibaba is like the Amazon of China. They also have a payments division. I think it's called Ant Financial. I bought about $7,000 worth of stock recently. I bought it like a couple days too soon. Obviously, Friday was horrible and today was horrible. But oh well, I'm going to own the stock for a while, so it doesn't matter too much. But now the stock is looking relatively cheap. It's near its 100-day moving average. It's near the blue line, which might be a good time to buy. Every time it's touched the blue line or gone under the blue line has historically been a wonderful time to buy. So I do feel pretty confident with my shares in Alibaba. And because they are like Amazon, but like I think of it like a cheaper version of Amazon, and China is actually growing quicker than the United States. So to me, this is a no-brainer. Although, so far I am down on my shares, but I don't expect to be for long. So let's look at the earnings of Alibaba. They had a little bit of trouble in 2016. They had some issues with the government, but it looks like on an earnings basis they went up. But as you can see, the stock for about 18 months was, give or take, it was flat. I'm sorry. I'm getting this confused with Baidu. Alibaba is the e-commerce one. I was already thinking of Baidu. Their earnings per share, as you can see, it was up to over $4 a share. Now it looks like it's climbing to up to over $4 a share. Up to $4 a share. Alibaba is one of those companies. Their revenue is growing. I think they have something called Singles Day, which is kind of like Amazon Prime Day or kind of like Black Friday type of thing. And Alibaba has loads of sales during those days. And Alibaba does own Ant Financial, which is a payments company. So I think it was a little bit more like, for those of you that don't know Alibaba, a little bit more like owning Amazon with kind of a PayPal aspect to it. So Alibaba is not a cheap stock. Over here we can see that it is closer to 60 times earnings than 30 times earnings. This isn't an exact science, what I'm looking at right here, but I'm just not paying attention to the PE ratio too much. Let's see if it says, right up here it says it's a 53 PE ratio, which was kind of expensive, but this is a super high revenue growth company. So I'm not too worried about it, and I think Alibaba is going to do okay. And from a technical perspective, it does look like it is trading right near its 100-day moving average. And I think that is the time, if I had to buy more shares, I would be buying more shares right around $180. So I'm pretty comfortable owning this. And my favorite stock of the bunch is Baidu. Baidu is maybe an $80 billion company. So it's actually smaller than the other 7 we just talked about. So Baidu, I own a couple of options, and this, I think it's a phenomenal company. This is a 2-year chart, and it is far below its 100-day moving average. It is $229 right now. So this company on a PE ratio, if memory serves me right, is about 33 times earnings, give or take. It's not a cheap stock, but they are growing revenue at about 33%. So I think the stock is too cheap right now. Actually, since I had some price drops, it might be about 30 times earnings now. But I think, in my opinion, I think the stock should be well over 260, heading towards this upper edge of the moving envelope. I think it should be heading towards about $281 a share. This is a fantastic company. They own the Netflix of China, which is iQIYI, and they should be spinning that off. I don't know how to say that, but they do license some of the shows from Netflix. So I think Baidu is a fantastic company. I thought I'd just include it here because Baidu is one of those companies that is just way down, and it looks like it's near its lows, its previous lows from November and December. So now might be a fantastic time to buy. So let's look at their earnings here. Let's go BIDU. Baidu is not in the category of one of those stocks that just goes straight up. If you have owned this company for like 10 years, then you have done fantastic. You've probably made many times your money. But over the last 2 or 3 years, it has done well, but not fantastic. And depending on where you bought, maybe it has not done well for you at all. If you've bought at one of these highs in 2015 or 2016, it sold it soon after. So Baidu is a growth company. They did have some trouble with the Chinese government in 2016. I don't know exactly what that trouble was, but it does seem like it's in the past. And as we can see, it's not a cheap stock. It's trading about 30 times earnings right now, according to big charts. But because they have the potential for good news, and because they are not one of the more expensive, actually it says right here, 29 times earnings, because they're not one of the more expensive tech companies, and because they're basically like the Google of China. I read somewhere that Google has 65% market share in America. And we've heard people say, oh, let me just Google that. So Baidu has 70% of the market share in China. So Google has 65% of the market share in America. I think that's what I said. Baidu has 70% of the market share in China. So more people might be saying, let me Baidu that in China. It's actually more of a common term than Google is in America, which is amazing to me. So this is $228 a share, give or take right now. So this one I wanted to end with because this is my favorite. I do own options in this company, and I might buy more. It's looking like it's near a midterm low or a short-term low. So if we look at this chart, the 2-year chart again, November, let's see what they touched on. They touched on 226 in December. They went down to 225 at one point. So it looks like it's right near its lows. And because Baidu is such a terrific company that is really growing and has a lot of things going for it, it might be a terrific time to buy some shares now. I know $229 is expensive for some people, but if you've made it this far in the video, you're probably an active trader and the share price to you does not matter. So thanks for watching. Again, I am a new channel, so please help me share my videos on Facebook or Facebook groups or something like that. And thanks for subscribing. Have a great day.